Good day, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for 𝗧𝗶𝗱𝗲. Today is Monday. It is the 10th of May. It is the second trading week of May. And boy, oh boy, we're getting into the summer. It's actually heating up. It's going to be about 90 here today. I know it's still cool in some parts of the country, but you're almost there. Let's talk about what to expect this week, and then we'll get into the daily plan of attack. So, not a lot of news first part of the week. We still have earnings. We got a lot of international trade stuff, but we're going to get pretty deep into numbers as we get into Wednesday, Thursday, and Friday. By the end of this week, we're going to have a really good idea of how retail sales are doing, which is really important. We're going to see whether consumer price index is going higher or lower. Very, very important. We're going to know if producers' price index is higher. So these two are very good numbers, the consumer and producers, for inflationary pressure. So we're going to know if there is inflationary pressure, and I bet there is, by end of Thursday. Then on Friday, and then Thursday, we're also going to have the jobless claims. And then on Friday, we're going to have industrial production and consumer sentiment. So we're going to have a fairly good idea of how well consumer sentiment is moving, if we're having inflation, and if industrial production is roaring or cooling off. It's going to be a really good idea to tune in here towards the end of the week. Well, it's good. It's a good idea to tune in here every day, but it's a really good idea to tune in towards the end of the week as we go through the retail sales numbers, the jobless claims, and business inventories and industrial production. These are going to give us a really good indication of what's really going on under the hood. Now, let's talk about global economy a little bit, all right? Job reports on Friday was disappointing. To say it was disappointing would be an understatement. It was really odd, too, and I'm going to explain to you why. On Thursday, we had a jobless claims report, and the jobless claims report was amazing. I mean, it was the best we've seen. I mean, we're doing really, really good, which means and this is a very timely report, which means as of last week, very few people were applying for unemployment benefits, all right? But on Friday, when the employment situation happened and we looked at how many people were actually applying are in the workforce, the number is very, very, very low. So it looks like less people are applying for jobs, and it looks like less people are looking for jobs. So it's a really, really interesting factor. It's almost like Americans don't want to work right now. I don't know. I mean, that $1,400 check doesn't seem like it's going to go very far, but it's a very interesting number. So Thursday's number was really great, and Friday's number was, I mean, I think the expectations was between 700,000 and 1 million. And the number came out at like 255. It was pathetic. It was really, really bad. So we're going to have to keep a very, very close eye on the economy, especially during this period where it's very, very choppy, bumpy, and there's a lot of stuff going on. So in terms of job reports signaled investors, it looks like we're going to keep rates low. And actually, that's the reason why the stock market rallied on Friday, in case you're interested. Because the job reports was so bad, it's telling us that the economy is not picking up as fast as we would think it would, and that the Fed may not raise rates because we may need to have lower rates to survive this. And here's actually a write-up of what I'm talking about. The U.S. economy regained, this is actually a good summary of what I just described, so I'll just read it to you, is regaining momentum as the rate of COVID vaccines rises, but Friday's U.S. job report was a massive disappointment. The market's I should have just read this to you instead of going through it. The market's most anticipated economic data of each month showed employers added just 266,000 jobs in April, far fewer than the expectations of 975 jobs that economists were expecting. Steep drop from March's hiring pace of 770,000. So only 266,000 jobs when the expectation was almost 1 million. So the weak job report suggests the economy is still in recovery mode and bolsters the case for the Fed to keep interest rates low. And remember what he said, the heating up of the economy is transitory. That head of Fed, I got a couple of things to tell him. The Fed's been holding short-term rates as record lows and buying $120 billion in bonds every month, helping drive the stock market rebound from its pandemic lows. And it looks like based on the Friday's data, we're going to be continuing to do that. Now, this is the part that gets me. I'm really concerned about this because we're almost there. In Japan, worries are growing about tens of thousands of athletes and officials entering the country for the Olympics set in July. Many of the countries where people have been vaccinated, while the rollout has been extremely slow in Japan, with about 3%. Folks, 3% of the population inoculated so far. I don't know what the number in America is, but it ain't no 3%. I mean, we're doing really well. As a matter of fact, anyone who really wants the vaccine right now who lives in USA can get it. I'm getting texts, come here, Publix, this, that. It's available pretty much anywhere. So the only people who don't have it right now in America are people who don't want it. And if you don't want it, well, that's on you. So again, the big reports, we're not gonna have a lot of movement, I believe, till Thursday and Friday. I think Thursday's jobless claims report is going to be pretty big, and again, the retail sales. Remember, retail sales makes up 2/3 of the GDP. Looks like the Nasdaq is going to come down. Momentum levels are cooling off, and they have been cooling off for quite some time. I'm going to show you very quickly Nasdaq's momentum levels because we looked at the S&P last time. But if you look at the Nasdaq, and I'm going to say, oh boy, it's just a matter of time, folks, but we just can't sustain these levels. And look at that. We peaked out here. This is the highest level. The red line is the highest level we've seen since 2009 in 11 years. And it looks like we're coming off. And every time we come off these levels, we need to cool off. Look at these. We need to cool off. We need to cool off and go at least in the 50th percentile. So the odds are, over the next quarter, the odds are of seeing the QQQs, which is the Nasdaq 100, near the, let me just go back here. Moving back to the 200-day moving average, which is right here, or at least going to the twilight zone, is extremely probable based on the current momentum levels. It's almost a certainty. Now, I can't guarantee anything. My first name is not Nostradamus, not yet at least. But the truth is, the odds are we're going to see a cool off. And I'm going to show you something else. Pay attention here. Look at these momentum levels. Look at that. We're going higher. Price is going higher. It's higher here than it was here, right? But that's divergence. That's divergence, folks. Higher price, lower momentum. Let me show you how that played out in the S&P real quick here, so you could see exactly what I'm talking about. Remember the crash? Higher price, lower momentum. Look at it right now. Higher price, lower momentum. That's the S&P. And now look at the QQQ. Higher price, lower momentum. What typically happens? We tend to cool off. So the odds are momentum levels and divergence is telling us that what's happening here, or what happened here, is exactly what's happening here. And it looks like we're going to cool off. Now, I'm not expecting a major crash. I'm just expecting us to go back to the mid between the 200-day and the 50-day line, or maybe hit the 200-day moving average, because it's just too much momentum too fast. Too much money being pumped into the market. Now, the Russell has been sitting on the 200-day, on the 50-day moving average. I don't know why I keep saying 200-day moving average. On the 50-day moving average. And I think that the Russell is going to start moving higher again. I don't think it's going to break down because momentum levels on the Russell are not as bad as they are on the Nasdaq or the S&P 500. Now, this is the bond market, and I told you that when we came down here, I don't think we're going to go much lower. And especially with this current economic data, which is telling us that nobody's working in this country or nobody's applying for employment, it's telling us that we're going to probably go sideways. I don't think we're going to go much higher because I don't think interest rates are going to really go lower, but I don't think they're going to go very much higher. So I think we're going to congest here maybe for another month, maybe towards the end of July, maybe towards the end of June or towards the end of July, and then start coming down again as the economy heats up and interest rates start moving higher. But I think for the time being, I think everybody's scared out of their wits with this employment numbers. I mean, 266 applications for new jobs, and we were expecting almost 1 million. That's not bad. Looking at the different sectors, nothing has changed. Financial, material, industrial, energy's number one, but you guys know my beef with energy. I have a beef because we are still below the levels of last February. So I'm not huge on energy, although I'll talk about some stocks today in the energy sector that I'm really liking. But I'm still moving towards the financial, basic material, and industrial stocks. I'm not really keen on the technology or consumer discretionary right now. As far as hot stocks, I've got some interesting ones for you. This 𝗧𝗶𝗺𝗧𝗃 Properties, look at this thing. Made a swing high, could have made an all-time high. Yep, all-time high. Now, what does 𝗧𝗶𝗺𝗃 Properties do? Is this a REIT? Let's take a look. Yeah, it's a REIT. Gaming, hospitality, entertainment destinations. Definitely a place that you want to be in right now. 89% annual return. Not a boring commercial real estate. Has some interesting entertainment properties that it holds. 𝗧𝗶𝗺𝗃 Properties. I like this stock, and I like the pullback, and it's bucking the trend real well. Next one, MGP, which is MGM Growth Properties, but the ticker is MGP. Also making a swing high, coming back down. Really good low-risk trade right here. And if you look at the profile of the stock, you will see real estate investment trust engage in acquisition, destination, entertainment, and leisure resorts. So both of these REITs that are doing really well are focused in entertainment, entertainment, gambling, that kind of stuff. Look at, I don't know if this is gambling, but yeah, developing gaming, hospitality, entertainment destinations. They both are doing the exact same thing, and I like these stocks right now a lot. So it's MGP and 𝗧𝗶𝗺, and I like this one. Now here's an interesting one. It's Freshpets. And what does Freshpets do? And I must have talked about it before. They manufacture natural foods, refrigerated meals for pets. People love taking care of their pets. And with the economy opening back up right now, people are taking their pets with them places. So they're feeding them more food. They're taking stuff out. Freshpet, Dog Nation, Dog Joy brands, all that is Freshpet. 145% return. And remember, pet fresh foods is a big trend right now. A lot of these nasty, cheap, canned, and dry dog foods are just not good for your pet. So Freshpets is a company I'm liking right now. It goes along with my whole theme. And it's consumer stocks, but it's not really a consumer tech stock. So I'm liking this stock a lot. FRPT ticker symbol, 𝗧𝗶𝗺𝗃, and MGP. And if you want to short, Clorox made a swing low, broke down, making it a higher high, and it looks like it's going to come down again right now. So 3 longs, 𝗧𝗶𝗺𝗃, MGP, and Freshpet. And as far as short, we have Clorox. Now, don't go anywhere. I've got something really important, timely, and really something you're going to benefit from. We've gotten a flood of new data lately, folks, and most of it has been really positive. But momentum levels are around historic highs, as I just showed you. And inflationary risk is present. We've talked about this just now. The situation created a choppy environment. Look at the Russell. It's just like sitting at the line, at the 50-day line. So what's the best way to trade these markets, you may ask? Well, you find a solid strategy for all 3 market climates. So if it's going up, you're golden. If the market's going choppy, you're golden. If the market's going down, you're choppy. So it doesn't matter what the government, economy, or the markets do next. Wall Street legend Chuck Hughes is unveiling his 3-piece blueprint that's giving everyday traders the chance to profit on stocks regardless of the current market direction. There's a strategy, a real premium strategy for bull markets, choppy markets, and down markets. And he's never, ever presented anything like this. This is a first time he's doing this for Wealth Press, for TradeWinds, and for everybody. This is completely unveiling something new. Folks, make money regardless of market direction in this type of crazy market. Click on the link below to learn more about Chuck's triple threat and see why so many traders want access. When Chuck showed me this, man, I was like, this is just great. I love this. 3 different tactics, 1 system, 3 tactics to take advantage of any market cycle. And I mean, really take advantage, not just hedge yourself. Folks, we're going to be unveiling this. You've got to check this out. This is really cool. And Chuck is unveiling this for the first time ever to the public. Never has he done this. This is the first time for his clients, our clients, all clients. First time ever. So this is brand new. You've never seen anything like this. Chuck is red hot right now. And as always, make sure to like this video, subscribe to this channel if you're watching on YouTube. Stay ahead of the market by being the first to be notified when we post new videos. And folks, you've gotta check out the triple threat. It is literally a triple threat. Chuck has completely just unlocked the key to what makes this market tick, and you've got to check it out yourself. Follow the link below. And have a great day. Bye, everyone.